Hi everyone, and welcome to my quick reference guide for the Introduction to Corporate Governance course. What I would suggest is that you keep these slides with you throughout your entire syllabus for this semester and going forward, because in this set of slides I'm going to deal with concepts that are broadly across the entire topic of corporate governance and with which you will need to be very familiar, and you can refer back to this as simply as a quick reference guide. If you're not sure on something or something doesn't make sense or where does it fit into the whole picture, this little reference guide is meant to provide you with a little bit of context for the overall syllabus, as I say, throughout your whole academic career. And you can even use it in profession. So I'm just going to go through the next 20 slides and just explain some of these concepts to you. So accountability is the obligation of an individual or some organization, such as a board of directors, to account for its activities and to accept responsibility, and then to disclose in a transparent manner how it has discharged that responsibility. So this is particularly in our example with regards to directors being held accountable for their actions, how they look after a company, by the shareholders. Responsibility is the duty or an obligation to perform a specific task, such as look after a company or implement a strategy. And if you fail to do that, you will have some sort of penalty. And part of that responsibility is that you will then have to report back to the person who gave you that responsibility on how you discharged it. Both of these concepts are related to the agency theory. The agency theory is where one person appoints someone to act on their behalf. So if you think of a company, the shareholders own the company, but they can't necessarily run it. So they appoint the directors to run it on their behalf. The directors, to some extent, have an agency relationship with the shareholders in respect of the company. If you think of the company as being like a child and the directors being their caretaker or a school teacher, or even just a nanny if it's a baby, and the shareholders being the parents appoint the nanny to take care of the baby on their behalf. And in that same set of circumstances, so an agency relationship is created. And out of that relationship, the shareholders can expect to have to be able to hold the directors accountable for their actions, and the directors have a responsibility to the company to take care of it, and the shareholders can expect the directors to report back to them on how they perform those functions. Stakeholders is any party that has some interest in a business entity and how it operates. And that includes people very close to the company, such as the shareholders and the board, the various directors and employees, and can extend very, very broadly to investors who have invested their pension fund money into a company with the hope of a return. Shareholders are the people who actually own the company. Now, shareholders and the concept of shareholders are limited to companies. So you obviously cannot be a shareholder in a closed corporation, and I will go through some of those distinctions just through the syllabus. Shareholders is a specific reference to companies because companies are divided up into shares, very much like a pie that's divided up into certain slices. And then there's shareholders. Shareholding is represented by a share certificate, and they have a legal right, they legally own a certain portion of the company. Beg your pardon. Board of directors is the collective reference for all of the directors of the company. The directors are the people who are appointed to manage a company. Again, directors is a term that we use specifically referencing companies. So you would never have a director of a closed corporation or a director of a partnership. Directors, like shareholders, is a concept that is specific to companies. Directors have fiduciary duties. So when we talked about the agency relationship, when the shareholders appointed the directors to act on their behalf in the best interests of the company, that is a fiduciary relationship, which means it's a relationship of trust. When you drop your child off at school to go and be taught by the teacher, the specialist, in that regard, you're not a teacher, so you outsource that function in respect of your child. And if you think of the company as being like your child, you have a fiduciary relationship with the teacher, whereby you believe that the teacher is going to act in the best interests of your child. In the same way, stakeholders generally can expect that the board will act in the best interests of the company whenever they make decisions. Shareholders often like to think that directors have a duty to act in the best interests of the shareholders, but that is not correct, and you must remember that and internalize it. The directors owe the best interests of their best interests to the company. And that's set out in Section 76 of the Companies Act, and something that we will cover in a great deal of detail in this program and going forward. The company secretary is then a person appointed in terms of the Companies Act. Certain companies must have company secretaries, and they are recommended by King for companies that are not required by the Companies Act to be appointing a company secretary. They are responsible for compliance with the Companies Act and the Memorandum of Incorporation, and overseeing corporate governance, generally speaking. Let's have a look at the responsibility and accountability relationship. Just looking at that concept of accountability and responsibility that we find in that agency relationship. So the shareholders are the owners of the company. They appoint the directors to take care of the company. The directors are accountable to the shareholders for how they manage and look after that company, and the directors are responsible to the company to ensure that the company, which is a legal person, remains secure, that its assets remain secure, and that it discharges all its legal obligations. And that is why the directors owe their their duty of best interest to the company itself and not to the shareholders. Let's look at the broader stakeholder relationship. So you have the owners of the company, being the shareholders, who've appointed the directors to manage the company. Everyone involved with the company in some way, shape or form, or has an interest in the company, will be considered a stakeholder. Lots of companies have common types of stakeholders. Employees are stakeholders in that they depend on the company for secure jobs and for their employment contracts to be met. Funders who may lend money to the company expect that money to be repaid and for the interest to be paid to them. Customers expect the company to deliver the products and services that the company promised. The community depends on the company to operate as a good corporate citizen, not to pollute the environment, but to rather create jobs, to assist with developing the community as a whole, part of the broader element of being a member of society. Suppliers are customer are the company is their customer, and they expect those supply arrangements to be honored and agreements to be maintained. Regulators oversee the company's compliance with regulation, and they are interested in ensuring that the company meets those obligations, that it complies with regulations, that it pays its license fees, and it contributes to the industry as a whole. So financial services companies will have very specific regulators that they need to answer to, and that's in the public interest. The JSE is a regulator of listed companies, so any company listed on the stock exchange will need to comply with the JSE listings requirements, and that is our broader scope of stakeholders in the company. Let's look at our legal universe in which we find corporate governance taking place, particularly around our syllabus that we will be dealing with this semester. So the first piece of legislation that we have is the Companies Act. So if you can download a copy, that will be absolutely fine. It's freely available online. And if you can order yourself a little book like this, you can get them from various publishers. This one I got from a law firm. So if you know a friendly law firm, ask them if they've published the Companies Act. And then what I've done is I've actually just labeled the sections that I find that I have to reference the most often, and I've put them into little color categories so I can quickly go through it. This is my second version of the Companies Act because my first version got so used that I think it became a health hazard. So you will need to use your Companies Act a lot throughout your entire career. So if you can get it in a nice organized form right up from the beginning, you'll be helping yourself. The Public Finance Management Act applies to state-owned companies. The listings requirements applies to companies that are regulated by the JSE, that are listed on the JSE, and the King reports apply to all entities, not just companies. In the context of this course, we talk about companies, but the King reports, the King codes of corporate governance apply to all entities. So your school governing board, your homeowners association, those pesky people that tell you to turn the music down in your complex, King actually applies to them as well. And it applies to state-owned entities, so even right through to our SAA and Transnet and Eskom. We're all in this basket, and we'll talk a lot about King and what it entails. And then specific pieces of regulation that govern state-owned regulators and specific entities. There are Chapter 9 institutions such as the Auditor General, ICASA, the Financial Services Conduct Authority, the Public Protector. If you work for the Post Office, you have your own piece of legislation, and that then has its own regulations, and so that will obviously be governed by those pieces of regulation, and will need to comply with them. Acts are mandatory. So the Companies Act, Public Finance Management Act, and any specific pieces of regulation will be mandatory. The JSE listings requirements obviously mandatory for listed companies, but not for other types of companies. So obviously if you're not listed, you don't need to comply with them. The King reports, as I say, it's a voluntary thing, but it does apply to all sorts of types of entities. Let's have a look at different types of entities or business structures through which you can do business. So you don't have to do business through a company. It is the most common form of doing business for various reasons. There's pros and cons, but there is nothing to stop an individual in their own capacity starting a business. There's just pros and cons to how it is that you decide to structure your business. So a sole proprietorship is one individual, me, myself, and I'm going to start my own business. I'm going to run it in my own name. If I enter into a contract, it will be me, myself, Karen Robinson, entering into that contract, and I can call myself trading as Karen's Coffee Shop. That's absolutely fine, but at the end of the day, the person who will get sued is me. If I die, then Karen's Coffee Shop dies with me. That's the end of it. All the assets in Karen's Coffee Shop belong to me in my personal capacity. There's no registration process. I don't have to tell anyone that I'm doing it outside of maybe the health inspector would be interested to know that I don't have cockroaches in my coffee shop. And I would have my own personal tax obligations. If I earned so much money that I needed to pay VAT, then I would need to pay VAT, but it would be me in my personal capacity. The challenge with that, of course, is that if I die, my entire business goes into my estate, and or I get sued. This very angry person will come back and sue me in my personal capacity. I can't. I've got no protection in terms of separate legal personality, which we'll discuss when we get to companies. But I don't have to appoint a board of directors. It's just me, myself, and I. Now that's absolutely fine if you're a small business, but you can imagine that could be quite constraining if your business grows. So the next step in a growth business might be to have a partnership. This is exactly like a sole proprietorship, but it's like two or more coming together to do exactly the same thing but together. Again, it is not an incorporated entity, which means there is no legal personality in this entity. It is individuals working as if they were sole proprietors, but working together. They can have an agreement where they decide who will be in charge of what, but that agreement is only enforceable between those parties. It's not enforceable against the third party. So if they enter into a contract, they will still be entering into a contract in their personal capacity. They will still be sued in their personal capacity. If one of them dies, then those assets will not be protected. They will go into the person's estate, and then the other person who was in business with them, now those assets are sitting in his partner's estate. How is he supposed to run the business? So there's a downside to that too. The upside, of course, is that you don't have to register anything. You don't have to have a board of directors. You'll still be taxed in your own personal capacity. So it's a sole proprietorship plus a few friends. Then you can have a private company, which is the first time we start seeing a formal juristic body. And this is a legal entity. You register it on SIPC. So if you go to www.sipc.gov, it's the commission for that in the regulator which oversees the Companies Act and the registration of companies. You only need to have one shareholder and you only need to have one director. So this is like a sole proprietor, but now he's gone and formalized his or her business into a separate legal person, so into this company. And then the company itself has rights and obligations, so the company can go and contract with people, and it can be sued, and the shareholder and the directors are somewhat protected from that. If the director dies or the shareholder dies, then the company remains, it continues to exist, and the assets all sit inside that company. The downside is that you do have to go and register this in order for it to take place, that as soon as you become a director of this company, you have this fiduciary relationship whereby you are responsible for the best interests of the company and not the best interests of the shareholder. Even if you are the shareholder and the director and it's only you and yourself that are involved in it, ultimately you are now taking care of a baby, so to speak. So the best interests of the baby is what is paramount. Obviously, income tax and will now be levied against the company, and the VAT will be levied against the company, and you have the Companies Act coming in. When you start to have a very big company, when things start to get quite big, and you want to trade those shares and you want lots of different shareholders to come in, then the business model would be better to have a public company. And you can take a private company and convert it into a public company, or you can register a public company right from the start. The idea is that in a private company, those shares are restricted. So if you think about a pie and you're sitting around a table with friends, you get to invite those friends and you get to pick who eats their pieces of that pie. But with a public company, you don't. Anyone can take that piece of pie that they own and they can sell it to anybody else in the public. You don't get any say. None of the other shareholders get a say in who else comes to sit at the table to eat the pie. And if that is the best or simplest explanation I can give you, the legal reference is that in a private company, the shares are restricted. Trading is restricted, i.e. we pick who we eat our pie with. In a public company, it is not restricted. Therefore, anyone can come along and eat our pie. And we may or may not like that. So that's what we must consider when we have a private or a public company. A state-owned company is a company where the majority shareholder, so being over 50%, is the state, is the government of South Africa. And it can be that they are wholly owned, which means that the government owns all of it, like with SAA or with Eskom or with Transnet or with PRASA, or it can be that the state owns some of it, which is like Telkom, where Telkom has the shareholder, the major shareholder is the state, but the balance of the shares are on the stock exchange and the public can buy into it, and it is a listed entity. And they will then be subject to the JSE listings requirements and the Public Finance Management Act and the Companies Act. So it's quite an onerous obligation. Obviously, if you were a sole proprietor or just one person, this is not the structure for you. This is the structure that is purely reserved for the state to operate business. Let's have a look at King and the King reports and where they come from and some of the history, because I'm quite sure that if you signed up for this course, you've heard of King. So let me give you some history into this. So King 1 was published in 1994. It was the second formal corporate governance report to be released in the world. The first one was released in the UK. It was the UK Corporate Governance Code, which subsequently became the UK Combined Code, and it was published in 1992. So South Africa was quite quick off the mark in terms of having a formalized governance recommendation. What was quite significant about it being published in 1994 was a year that is entrenched in our own history so well. We became a democracy, and we all, our rights, we became equal citizens, but the law had not caught up. So the Constitution itself had not come into effect in 1994. There was no Employment Equity Act, there was no National Environmental Management Act, there was none of those things that prop up an equal democracy that we had in 1994. So what King did was it firstly identified stakeholders. So there were more people who had an interest in how a company was governed aside from simply the shareholders and the directors. So it identified employees and communities. And then what it did was it made a lot of recommendations around how the company engaged with those stakeholders as a good corporate citizen. Essentially what it did was it provided a stopgap between when democracy came in and that legislation that supports democracy became enacted. So it was a very important piece of literature for South African society at the time, because it very quickly provided our constitutional rights, even though they hadn't yet been provided. It started providing that guidance around those rights. Come 2002, our constitution was in place, and all the legislation that was required in order to support that legislation was well underway. So we had the environmental acts were in place, we had the employment equity acts in place by then, and we were starting to see the first drafts of the BEE legislation. So in some way, the purpose for King 1 had kind of been had fallen away because and been replaced by the legislation. However, there were still a lot of things that required broader consideration outside of just legislation. So corporate governance is made up of legislation, regulation, codes, ethics, and company policy. So legislation had been ticked off, but everything else was still kind of needing that support. So King 2 then stepped in and focused on triple bottom line reporting, which was the first time we start to see thinking about stakeholder interests in a more formal manner. And triple bottom line reporting is also referred to as people, planet, and profits, or the triple P reporting. So when a company does business, it must consider the impact that it has on people, the impact that it has on profits, and the impact that it has on the planet. So you couldn't run a business and make profit without impacting people or without impacting the planet. And we started to see the beginning of sustainability reporting in those days. Both King 1 and King 2 were on the basis of comply or explain. All of the King reports are voluntary. They are not required to be complied with by law unless they have been incorporated formally into a piece of regulation, such as the JSE listings requirements. So what they said is, here is a bunch of regulations. Comply with them or explain why you haven't complied with them. So what we were seeing in 1994 up until about 2008, when King 2 was still in place, until King 3 came in, this comply or explain, what would happen is companies would say, we comply with King 3 substantially. And people would go, well, that's cool. There's a whole bunch of recommendations in these King reports. What do you mean by substantially? What does that mean, that you do some of them but not others? Which ones do you do? Which ones don't you do? So it became necessary to require companies to be more specific about how they complied. And come 2008, the New Companies Act, which we still refer to as the New Companies Act, although it came into effect in May of 2011, it's still dated 2008. So King had to then be redrafted and revised and updated in order to meet the requirements of the New Companies Act and to support the Companies Act. It was at that time that they decided that the concept of comply or explain was really dated, and that apply or explain would be far more relevant to companies. So what this meant was the principles in King, the companies should apply those principles or explain why they haven't applied them. And there's 76 principles in King 3. So this then gave rise to a checklist that companies would develop with 76 principles, and then we would just tick boxes as to which ones we had applied, and where we hadn't applied them we would give an explanation. And that was all well and fine. And of those 76 principles, I think every single one of them is a very good idea for running a successful business. However, 76 principles is a hell of a lot, particularly if you consider that this is a document that's supposed to apply to every sort of business entity, from your homeowners association and your school board all the way through to a state-owned entity. So it became a bit secularized, and smaller companies were saying, hang on a second, this is something that just I can't do. I can't do 76 principles. This is insane. This is something for listed companies and for banks. So King 3 became very polarized in its application in bigger entities, and smaller entities were kind of left out and really didn't take it to heart, which is a pity because there was good recommendations in those principles. But recognizing that, still brings us to 2016 and the publication of King 4. And firstly, what they did was they took 76 principles and they refined them down into 16 principles. And the best way I can explain this is those 76 principles are good stuff. They really are good stuff. But they might have been a bit watery. So if you think about gravy, if you've ever made gravy, so you start off with your big stock pot, and it's like full of like liquid, and you've drained your chicken in there and all your vegetable stock and everything, and you've got like this big soup, and it's very watery, and you know it's good stuff, but it's not gravy, and you don't want to pour that on your potatoes. So what you do is you leave it and you reduce it, and it simmers down and it simmers down and it simmers down, and you get rid of all of the water, evaporates, and you're left with that really good stuff, that gravy, that thick, all the good stuff is in there, but you've got rid of all of the peripheral water. And this is a gravy that even your mother-in-law is going to love. That is what the transition between King 3 and King 4, that's what happened. So we went from 76 very good principles, and we condensed them and refined them down to 16 principles. And then we changed it slightly. So there's only 16 principles, but now you must apply them all. And these 16 principles we will go through, and you'll see that they make really good sense. It doesn't matter what size your business is. These 16 principles you need to apply whether or not you're a sole proprietor or a state-owned entity, because they just make good sense. So the requirement is that you apply them and explain how you've applied them. Some of that content in those 76 principles has now become what we call recommended practices in the 16 principles. So if you want to show how you have applied this one of the 16 principles, you could have reference to something that was initially one of the 76 principles in King 3. And we'll go through King 4, and I'll show you how it's been translated. So it's become a very good business tool now, not only simply to say that we apply the 16 principles of King, but that we really are cognizant of the fact that these are good ideas for our business, and they are going to ensure the long-term sustainability of the business. Let's have a look at what the various King reports applied to. So just another way of looking at a similar slide that we had. King 1 applied to companies on a comply or explain basis. King 2 also comply or explain, had a broader application. King 3 brought in the concept of all entities, and King 4 has maintained that all entities. We've moved from apply or explain to apply and explain, and we've synthesized our 76 principles in King 3 down to 16 solid business ideas. In terms of directors' responsibilities and fiduciary duties, before the Companies Act came out, it might surprise you to know that they were not included in the previous Companies Act. So in the 1976 Companies Act, we did not have directors' duties. There were all sorts of other things, but directors' duties were not part of the Act. They were part of common law. And then in the 2000 Act, our new Companies Act, now we have them in Section 76. King, however, also supplements what is in the Companies Act by talking about the duties of a company, of the directors to the company more broadly than might be applied in the Companies Act. So concepts like integrity, competence, responsibility, accountability, fairness, and transparency. The whole focal point of the King recommendations focuses on 4 of those 6 pillars: fairness, accountability, responsibility, and transparency. Now, if you remember them in that order, I promise you, you will never forget them as long as you live. Lesson tip. Any company can apply these 4 principles. Think of them as the 4 pillars that hold up the house of the business. There's no way that you can behave unfairly and be in the best interests of the company, or not be transparent and for that to be in the best interests of the company, or not to be responsible and that to be in the best interests of the company. They are voluntary in nature, the idea being that ethics cannot be legislated. However, there is no unethical business decision that can ever be in the best interests of the company. All of the King reports apply the stakeholder inclusive approach, which means that we look at that very broad group of everyone who has an interest in the company, and we say, in order to determine what is in the best interests of the company, we must consider the interests of all the stakeholders. It will probably be that some stakeholder interests have to be prioritized over others. We may simply not be able to meet everybody's expectations at the same time. That's a reality of the world. We have finite resources. But we cannot decide what is in the best interests of the company if we do not consider the interests of all of our stakeholders. And that is a fundamental principle that will run throughout your entire corporate governance career. The idea being that sustainability of the company benefits everybody. If that company goes under, we all lose. If the company continues and it continues to do well, then we all do well. So if we can all support the company's long-term sustainability, we will all benefit in the long run. The 16 principles really align with the company strategy. So it's about taking corporate governance away from being a tick box. We don't like tick boxes. We want things that make good business sense. So those 16 principles need to align with the company strategy. And when I go through them now, you'll see what I mean. The concept being that we take integrated thinking. So we take all of those interests of our stakeholders, we take all of our resources, and we make decisions taking all of those things into account. Companies have a finite amount of resources. So if you think about a company, it's got 6 buckets. It's got 6 buckets of things that it can use to do business. It's got financial, so it's got a bucket of money. It's got human. It's got a bucket of people that it can use. It's got a bucket involving its social environment and its community in which it operates. It's got a bucket of manufactured goods that it relies upon. So cement making company, any type of mining, they need manufactured goods. It has a bucket of its natural environment. How much oxygen, how much pollution, how much carbon emissions, what kind of waste does it produce? It has intellectual capacity. So if it wants to fill up that bucket, it's going to have to put something into the bucket. This is how we do our business. This is, if it's a medical research, how much investment do we need to make into the intellectual capacity that we have to conduct that business? And this is the basis on which we form our social, our entire integrated thinking. So if we want to take everything from those buckets and build a business with them, these are our finite resources. So we have to take this into account as we make our strategy and as we roll out our strategy. Let's go through these infamous 16 principles. I'm not going to go through them in a great deal of detail, but I'm going to just highlight the key aspects. So the board should lead ethically and effectively. The board should promote an ethical culture and is the center for ensuring that the company is seen and acts as a good corporate citizen. The company and the board must realize that risk, opportunity, strategy, business model, performance, sustainability are all inseparable. You cannot take risk out of strategy. Strategy and risk live together in the same universe. You cannot have performance without having risk. You cannot have a community purpose without thinking about your business model. If you want to create value, you have to think of all of these things together. Reporting means that you are able to make sure that your stakeholders understand your short, medium, and long-term prospects and how that impacts them, off the basis of the fact that in order to make good decisions for the company, you have to understand your stakeholders' interests. The board will always be the focal point for corporate governance in the company and the custodian of corporate governance. And in doing so, that board must be properly constituted. There must be the right people who sit on that board. It can vary tremendously depending on the type of company and the size of the company. It really is about what the company needs, but it needs to have a suitable balance. So if we have an engineering firm and the only people who sit on the board are engineers. So we have a board of 10 engineers. That's awesome. We'll have a great engineer. We'll have a great engineering capacity. But how the hell will we pay for it? Because we've got no accountants. So we don't understand the financial statements and we don't account for things properly. It's going to fall down. Equally, if we have no lawyers, we're going to make bad contracts and we're not going to think about legal risk. So we need to have a balance of skills in terms of our knowledge, our experience, our qualifications, but also our diversity and our independence. So just to come on to diversity for a minute. Diversity in the sense that is very close to home in South Africa in terms of race and gender is very important. So we need to be equally representative. This is a very important aspect for the business, for the success and the sustainability of the business, because different ideas coming together means that we can have good quality ideas. If we all sit around the table and we're all the same age and we all come from the same background and we all went to the same university together and we're all friends off site, we're all going to come to the same idea. No one's going to challenge anything. If we want good quality ideas, we need diversity of views. We need to understand what impacts different areas of the business. And one individual will never know everything. You need the difference in all of that wisdom to come onto the board. So there is a legitimate business reason for diversity. It is incredibly important, over and above the other important initiative, which is around equal empowerment. Then on independence, we will talk about independence, and I'll explain the difference between independent executives and executive directors. But independence means that they have no interest in this business other than the business doing well. So we have to make sure that we balance those stakeholder interests. The board should promote independent judgment and a balance of power. So everyone on the board should be able to air their own views and bring that quality of their discussions and their experience and their skills. And there shouldn't be a board of 10 people, but really only one person makes any decisions and everybody else just sits there and is quiet. The board must then evaluate its own performance. If the board is going to be responsible for all of those items from 1 to 8, then it really should evaluate its performance and ensure that it continues to improve its performance by identifying what it hasn't done well and where it does need to do better. The board itself will be the entity that oversees the strategy and the development of the strategy. And in the next 6 points, we'll talk a lot about strategy and supporting strategic objectives. The board is the custodian of the strategy, but it itself does not physically go and do the work of implementing the strategy. The board needs to delegate that down to management to implement. So you don't see your non-executive directors coming and doing your creditors clerk work. There is somebody who needs to do that, and they need to delegate it down to the creditors clerk to do, and that's absolutely acceptable. But how they delegate that work is very important. So there needs to be a process where the board picks the right people to delegate to, and then properly delegates that responsibility. And it comes back again to this concept around the agency theory. And once you delegate down responsibility, then there is an obligation to report back up on how that responsibility has been discharged. When we look at risk, risk is the enemy of strategy. So you have your strategy, this is what we want to do with our business, this is where we want to go. What are the things that could stop that strategy taking place? Those are risks. So risks and strategy, they're like polar opposites, the two sides of the same coin. In a sense, there will always be risk. So when a board looks at risk, it has to consider and manage risk in a way that will support the strategy being achieved. And there are lots of, you can study risk management for years and years and years, formal ways in which you can manage your risks so that your strategy is still achieved. Technology and information, if anything, this time last year when I would give these lectures and people, we would go, oh yeah, we use technology, we use information, duh. Well, in COVID, where we are having to communicate with each other in the way that we're having to pull resources of information. Suddenly we're all working from home. How do we get into the central servers of the company? Who's got this document? How do you get that document signed? Brought home a real reality around how much companies depend on technology and information. If you took technology and information out of the company, what is left? How do they deal with their business? How do they do business? If you have no technology and information, how do you do it? You and I would not be talking today. So you need to make sure that you manage those things in a way that is going to support the delivery of your strategy. You must make sure that you are compliant with all the laws that apply to your company and adopt, where appropriate, all the non-binding regulations and codes. So, minimum requirement, you must comply with the law. That's a no-brainer. There's nothing more boring than paying a fine to the Competition Commission when you could have paid that as an incentive to your staff for doing the right thing. It also has significant reputational risk to go and break laws, which I think if you simply read any type of commercial news, you will know well. You must make sure that you remunerate fairly, responsibly, and transparently, and in a way that promotes your strategy. So if you have a strategy which you need to develop, you need someone to go and do it, the people that you delegate to. You need to pay those people. So you need to pay them in a way that is going to promote your strategy and deliver your strategy. That remuneration needs to be done fairly, it needs to be done responsibly, and it needs to be done transparently. And there's also a lot of academia which you go through in some of the more advanced years around fair, transparent, and responsible remuneration. When you have all of these things 1 to 14 together, you need to check them. You need for them to be somebody to be overseeing them and ensuring that they are taking place and that they're being done properly, and that integrity of information that is being reported back up to the board can be relied on. So you delegate down, you report back up. How do we know that that information that's being reported back to us, as either as directors or as shareholders, is actually correct? You have to have some sort of assurance mechanism in place. And this will be your internal control, your internal audit, and your external audit. And then you need to adopt a stakeholder inclusive approach, which means that when you consider the best interests of the company, you need to consider all of those interests of your stakeholder group. Let's have a look at a typical corporate structure for a company board. As we go through the syllabus, we're going to talk a lot about executive directors, non-executive, and independent executives, non-executive. So you're going to hear these words a lot. So let me explain up front what these concepts mean. So if you have a board of directors on a company, they will be made up of 3 groups of people. Executive directors, these are the people who are employed by the company. They go and work for the company from 9 to 5 and on weekends and whatever, and they depend on the company for their salary. This is typically going to be your CEO, your CFO, your COO, and if you have any other executive directors that you might sit on your board. Non-executive directors are directors who are not employed by the company. They don't come there every single day. You don't see them. You may not even have met them if you were an employee. But they are a director on the board. However, they have some other relationship with the board. So they might be representing a shareholder. They might be a customer of the company. There might be some other reason why they have some connection with the company, even though they don't work there and they're not employed with the company. Then you have independent non-executive directors. And these are also directors who are not employed by the company, hence the word non-executive, but they have no other relationship with the company. So they don't have shares in the company, and they don't have any supply contracts, so they're not customers of the company, and we'll go through various criteria. They have no interest other than they simply get paid a flat fee for coming and attending board meetings and for taking decisions on behalf of the company. The board itself will then divide up little subcommittees and delegate certain responsibilities to certain committees. So, The audit committee will be the primary responsibility for appointing the independent auditor, ensuring that the financials are properly assessed by an independent, such as an independent auditor, and that they're published in terms of the regulations. Audit committees are mandated by the Companies Act for public companies and state-owned companies, and obviously are mandatory for companies listed on the JSE. The membership is dictated by the Companies Act. You can only have independent non-executive directors on this committee, and you must have a minimum of 3. King says try not to have your chairman on this committee. They don't like you to have your chairman as a member of this committee. This committee is then required to make certain disclosures. They must, amongst others, say that they are happy that the auditor is independent, and they must comment on the financial statements that are published, and they must have some sort of oversight into the financial controls of the company. King recommends that if you are not required by law to have an audit committee, then you should at least have some sort of committee that has an independent component on it, some sort of independent non-executive director who oversees how the annual financial statements are audited. The Social and Ethics Committee is also a committee which is mandatory in terms of the Companies Act for listed companies, state-owned companies, and companies with a public interest score of more than 500, and they are mandatory therefore for JSE companies. And this is the committee that has responsibility for overseeing the company's role in social and economic development, being a good corporate citizen, the environment, health and safety, consumer relationships, and labor and employment matters. Membership is also dictated by the Companies Act, a minimum of 3 members. This committee can have executive and non-executive directors. It doesn't have to be limited to only independent non-executive directors, and it may include prescribed officers. This committee needs to make a disclosure to shareholders at the AGM around how it has discharged its responsibilities. And King recommends that if you are not required to have this committee in terms of legislation, then you should at least have a committee or a group of people who are looking at those 5 responsibility areas on behalf of the company. The Risk Committee is not required by the Companies Act and not required by the listings requirements, but King does recommend that somebody is looking after risk. If you consider that risk is the enemy of strategy, then it's a very important component of ensuring that your strategy actually works. So you could have a risk committee, which you can also combine with your audit committee, and this risk committee must identify all the risks to the strategy, the upside risks, which we'll discuss in part of your syllabus, and the downside risks, and ensure that there are proper mitigating actions in place. Executives can be on this committee, and it needs to disclose what the key risks are to the company and how those risks are managed. The nomination committee is not legislated and is not a requirement of the JSE. This is the committee that looks at how the board is constituted. How do we go about appointing those board members so that we ensure that we have that diversity, the level of independence, the right mix of skills and experience and knowledge to ensure that we can properly discharge our strategy. New directors coming in are properly inducted, that directors receive ongoing training because the law changes all the time and the environment changes all the time and industries change. So we have to make sure that our directors are up to speed with all of those changes. And we also look at how we evaluate ourselves and our own performance. Membership should be only non-executive directors, the majority of whom should be independent. If you do not have a nomination committee, then King recommends that there is someone on the board, or a group of people on the board who look over these responsibilities. Let's have a look at what it means to be a non-executive director and how we go about evaluating independence. So these recommendations come from King. If you are a significant provider of capital, so if you are a funder of the business, or you participate in a share incentive scheme offered by the company, or you own shares in the company that to an extent that is a valuable material value to you. So not just maybe one or two shares, but compared to your personal wealth, this is a pretty material shareholding. Then you will not be considered independent. If you have been an executive in this company in the previous 3 financial years, then you will be excluded. You cannot be considered independent. Somehow magically, on 3 years plus 1 day, you can be considered independent. If you were previously the auditor of this company or a key member of the audit team, then again you cannot be considered independent for this magical 3-year period. If you have an ongoing professional advisory relationship with the company, so if you have an acquisition expert who works for who that's what they do, they go about and broker acquisitions, and they're a member of your board and they have a contract with you to broker those sort of acquisitions, then they cannot be independent. This is typically also if you have your own legal advisors from your law firm, Cliff Decker, Hoffmeyer, or whomever. If they sit on your board but they have a contract with you, then they can't be independent. Significant customers or suppliers to the company, that relationship is very close. There's a material degree of value, so they would not be considered independent. Where a member of the board or the executive management is also a director on a related party company, so on another company which is related to the company, then you can't be considered independent. And where you find this nowadays typically is if you have a holding company structure, so you have a big holding company and it's got lots of little subsidiary companies at the bottom, and where you have one of those directors at the holding companies is now sitting on the boards of the subsidiary companies, then they would not be considered independent. If there is any part of your performance in your job that is you are remunerated in any way based on the company's performance. So if the company performs well, you get more money, then you would not be considered independent. If you've been on the board for more than 9 years, doesn't necessarily mean that you're not independent. It means that the board needs to consider your independence, because if you've been around for a while, then you may not really be objective any longer. I personally have a bit of a criticism with this, because 9 years is not a very long time for directors, non-executive directors, to sit on boards. And what we do want is a wealth of experience and history and knowledge of the company. And it is disappointing to see some of those directors being considered not independent. However, big investors, particularly the PIC, pay a lot of attention to this 9 years. And as soon as a director goes over the 9 years, you will find that the PIC will start voting against their reappointment. And so the board must reconsider every year after those 9 years whether or not they are still considered independent. The overriding rule is that a board must be sure that any director, a non-executive director, would, whether or not a reasonably informed outsider would still consider them to be independent, whether objectively speaking you could still say that they acted independently. So that's something the board needs to assess on an annual basis. Let's have a look at company secretaries. And this is often where you find governance professionals. You do not have to be a company secretary to be a governance professional, but I absolutely love this profession, so obviously I'm going to promote it. Company secretaries must be appointed to public companies and state-owned companies. They must have the requisite knowledge of and experience of the laws that are relevant to the company. They are responsible for ensuring that the Companies Act is complied with by the company and that the company's MOI is also complied with. And they have a duty to report to the board any failures in that regard. They must also make the board aware of any legislation that affects the company. So I just want to hover here for a moment. You do not need to be an expert in competition law or POPI or PIA or FICA, but you do need to know that those laws apply to your company, and you need to make sure that the board knows that and that the suitable experts then explain the implications to the board. So be sure that if you are a company secretary, you do identify all the other bits of legislation that are relevant to the company. You have a duty to provide your guidance to your directors with regards to their own fiduciary responsibilities. This is collectively as a board and as the individual members as well. And this is where all the soft, juicy stuff of being a company secretary comes into. Thereafter, the Companies Act does get a bit dull in terms of our duties. We also have to make sure that we pay our annual returns and we certify our annual financial statements. We must make sure that all our shareholders receive their annual financial statements. We must be permanently resident in South Africa, although you need not necessarily be a citizen. The company secretary can be another company. So there are some very good companies, Fluid Rock Governance, Corpstat, Morestat. They're actually companies and they act as a company secretary. As long as somebody in that company meets all of these requirements, then that's fine. And if there's any vacancy of the company secretary, then it needs to be filled within 60 days. Prescribed officers. These are a fun category of people. So these are people who are not directors, but who exercise some degree of control over a substantial part of the business, or the board depends on them to a material degree for information or to manage part of the business. This is typically going to be a senior manager, so the head of risk, the head of legal. If you have a subsidiary company structure, you've got a holding company, you've got a subsidiary company structure at the bottom, those managing directors of those subsidiary companies could be considered to be prescribed officers of the holding company. The implication with this is that while they're not directors of the company, by being a prescribed officer, they have exactly the same fiduciary duties as if they were directors. So that's quite scary and quite onerous. So the managing director on a subsidiary company would still have the same degree of responsibility as the director sitting at the holding company level. It happens as a matter of fact. It's not like you suddenly trigger a certain number of years that you've worked for the company or a certain appointment, and now you just miraculously you get a formal letter and says we herewith nominate you and appoint you a prescribed officer. It happens by matter of course. So if you fulfill these requirements, then you do become a prescribed officer, which means that it's important for the company secretary to ensure that these prescribed officers are identified. They understand that they are prescribed officers and they understand what that means in terms of their fiduciary duties. They also have the unfortunate experience of then also having to have their remuneration disclosed in the annual financial statements in the same way as the directors would. And the last concept I'm going to discuss here is the concept of the solvency and liquidity test. So when I said earlier that the company is a statutory entity and it can own its own assets, it has its own assets. And it trades in its business, and it pays its creditors, and it pays its employees and whatnot. And money goes out of the company in an ordinary course of business. That's absolutely fine. That's how you need to run your business. However, if there is money or an asset going out of that company that is not in the ordinary course of business, then there is an additional set of rules that apply, and they are there to ensure that the assets of the company are protected. There could be very good reasons why those assets need to go out of the company, but we just need to make sure that there's an additional protection in place to ensure that all those other stakeholders who have an interest in the company are not negatively impacted when those assets disappear out of the company. And that's the solvency and liquidity test. Typically, this applies to financial assistance, so any sort of loans between companies. If you have a holding company structure with subsidiary companies, any sort of intercompany lending between all of those companies, loans to directors, prescribed officers, any sort of security that is given, like a subordination agreement, and then any distribution to shareholders in the form of a share buyback or more commonly in the form of a dividend. This test needs to apply. And essentially what it means is solvency relates to the balance sheet. This is the assets of the company. After you've done this distribution or this asset has left the company, the assets, the remaining assets of the company, fairly valued, must equal or exceed the liabilities of the company. So the company must still be solvent. And then liquidity must also be assessed. This is your cash flow statement and your income statement. So once that payment has been made or those assets have left the business, the company must still be able to pay all its debts as they become due and payable in the ordinary course of business for the next 12 months after that distribution has been made. This is the trick. This test must be applied before those assets leave the company. If the board fails to apply this test, there will be a breach of their fiduciary duties, and that means that they can incur personal liability for the damages that the company suffers as a result of those assets leaving the company. So that is my little quick reference guide to corporate governance. These are the key aspects that come up in corporate governance on a regular basis, and I can guarantee you will be part of your exams. So if you move forward in this course, ensure that you have a solid understanding of what is in these 20 slides, and you can refer back to them at any stage. If you forget what something might be, you can always pop back and have a look and use this as your little dictionary.